What is going on, everyone? Welcome back to FX Market Pulse. Today, we are doing a complete gold breakdown, and I mean complete. We have the 4-hour chart in front of us. I am going to walk you through every single level, what price is doing right now, and then we are going to dive deep into the fundamentals, because this week was one of the most news-heavy weeks we have had in a long time for gold. We have the US-China trade deal, hot CPI data, Moody's credit downgrade of the United States, and the Federal Reserve holding firm. Every single one of these events has a direct impact on gold. So we are going to break all of it down, figure out the bias, and map out exactly where price is going next week. Let us get into it. All right, so I am on the 4-hour chart of gold right now, xauusd, and the first thing I want you to notice is where we are coming from. Look at that supply zone up at the top, the pink shaded area running from approximately 4,750 up to 4,764. That was the key weekly bearish rejection zone. Price pushed up into that area, got rejected, and we have seen an absolutely aggressive sell-off since then. That rejection was not a small candle. It was a multi-candle rollover, which tells you there was serious institutional selling happening at that level. That is not retail traders. That is smart money distributing at a premium zone. Now, let us talk about the levels on this chart, because there is a lot of structure here, and I want to be very specific. Key resistance levels, the ceiling. Starting from the top, we have the 0.5 Fibonacci level sitting up at 4884.5. That is your major macro resistance. Price hasn't even come close to testing that since the all-time high earlier this year. Coming down, we have the main supply zone, the upper pink area, between 4,750 and 4,764.73. This is the zone that rejected price aggressively. If you look at the left side of the chart, you can see the same level acting as support that then flipped to resistance. Classic structure. The market came back to that level, got rejected, game over for the bulls at that point. Then we have 4727.09 just below, and the PDH, previous day high, marked at 4718.95. These are your intraday supply reference points. If price retraces up into this area, that is where sellers are going to step in again. 4706.39 is the next level. You can see that on the right side of the chart as a dotted reference. Another point of control from recent price action. Current price and where we are. Right now, price is sitting at 4570.39. It has already dropped significantly from that 4764 supply zone. We are down about 20 points on this candle alone, minus 0.44% on the day. Price has been falling hard and fast. Now look at what I have drawn on this chart. There is a small pink correction box sitting roughly between 4570 and 4600, and that is critical. Price does not go in a straight line. What I am expecting to happen, and this is the setup, is a minor retracement back up into that 4570 to 4600 zone. This would be a fake out move, a bounce to trap any buyers who think the bottom is in. And then that is the continuation short entry. The liquidity zone, dollar signs. Now look further down on the chart. You see that gray area sitting below current price, around the 4500 to 4510 level. And I have marked that zone with the dollar signs. That is where the sell stop liquidity is sitting. Below every consolidation low, below every swing low, there are pending sell orders and stop losses from traders who went long. Smart money needs to go down there to sweep that liquidity before any meaningful move can happen. So the sequence is this. Small bounce to the correction zone around 4570 to 4600, then rejection, then a break below and a sweep of that dollar sign liquidity around 4500 to 4510 level. The target. After that liquidity sweep, the full bearish target on this chart is down at approximately 4,420 to 4,425. If you look at where price consolidated back in late April before the big rally, that zone at 4,420 is your macro demand level. And that is where I expect this move to ultimately resolve. That is a significant move from current price, roughly 120 points of downside from here. To summarize the technical picture, bearish structure, supply zone rejection at 4,764, current price 4,539, Expect a minor bounce to 4,570 to 4,600 short entry zone, then continuation lower through the $ liquidity at 4,500 and final target at 4,420. The PDL at 4,644 and the 4,637 level have already been broken, which is another confirmation that structure has shifted bearish. Part 2. Macro Fundamental Analysis. Now, this is where it gets really important, because this week we had 4 major fundamental events that all hit gold at the same time. And when you combine the technical picture with what just happened fundamentally, the bearish case gets very strong. Let me walk through each one. Event 1. The US-China trade deal, the biggest risk-off killer this week. Let us start with the biggest event, the US-China Kuala Lumpur Joint Arrangement. The world's 2 largest economies have agreed to stop escalating trade tensions. The arrangement includes reciprocal tariff reductions, suspended retaliatory measures, and a commitment from Beijing to lift export controls on critical minerals. Federal Reserve Bank of Cleveland. Now, why does this matter so much for gold? Because one of the biggest drivers of gold's rally earlier this year was the trade war uncertainty. When markets are scared, when there is uncertainty, when tariffs are flying around and nobody knows what the world economy looks like next month, investors buy gold as a safe haven. That safe haven premium was baked into the gold price. The decline in gold this week was driven by improved risk sentiment and reduced demand for safe haven assets after the breakthrough in US-China trade negotiations. As one senior metal strategist put it, the progress made in trade talks over the weekend significantly dials back trade tensions, stoking risk appetite and sapping gold's haven bid. Kiplinger. Under the current arrangement, the U.S. agreed to reduce customs duties on fentanyl-related imports from 20% to 10%, lowering the overall tariff rate on Chinese imports from 41% to 31%. The suspension of reciprocal customs duties of 24% will be extended until November 10, 2026. On the Chinese side, Beijing agreed to suspend retaliatory tariffs and ease restrictions on U.S. goods. And as of this week, Trump and Xi are expected to inch toward a managed trade mechanism for non-sensitive goods, with each side possibly identifying some $30 billion worth of goods on which they could reduce tariffs, a so-called Board of Trade mechanism first proposed by U.S. Trade Representative Jamison Greer. Bureau of Labor Statistics. So what does this mean for gold in plain language? Risk on is back. When equities go up, when the trade war fear premium comes out of the market, gold loses one of its biggest catalysts. That safe haven demand evaporates very quickly. And that is exactly what we have seen in the price action this week. The sharp drop from 47.64 was triggered in large part by the market repricing the risk-off premium out of gold. Event 2. US CPI. Hot inflation kills rate cut hopes. The second major event this week was the April CPI data. U.S. inflation came in at 3.8% in April, the highest since May 2023, above the 3.7% forecast. This hot print has killed any near-term rate cut expectations entirely, with traders now having priced out cuts completely through year-end. Trading key. And it was not just CPI. Data released this week also showed U.S. wholesale inflation surging at its fastest pace since 2022 in April, while consumer prices posted their largest increase since 2023. Inflationary pressures have been driven largely by the prolonged Middle East conflict and the near shutdown of the critical Strait of Hormuz, which has severely disrupted global energy shipments. Bar chart. Now here is why this is directly bearish for gold. Gold pays no interest. Zero. When you hold gold, you earn nothing. So the question every institutional investor asks is, what is the opportunity cost? Right now, the Federal Reserve is sitting at 3.50 to 3.75%. According to CME Group, the probability of a rate cut to 3.25 to 3.5% in June stands at just 2.6%, while 97.4% of market participants expect rates to remain unchanged. Keeping borrowing costs at current levels limits the upside for gold. Federal Reserve Bank of Cleveland. Some traders are now even starting to price in the possibility of a rate hike by December. Think about that. When the market is debating whether the Fed hikes rather than cuts, that is the most bearish possible environment for a non-yielding asset like gold.
Markets have now fully ruled out a Fed rate cut this year, with some traders increasingly pricing in the possibility of a rate hike by December. Bar chart.
Event 3. Moody's U.S. credit downgrade, the wild card. Interesting one because it cuts both ways for gold. On May 16, Moody's delivered a major verdict. The United States no longer deserves its perfect credit rating. The agency downgraded the U.S. government's long-term sovereign credit rating from AAA to AA1, citing significantly higher debt and interest payment ratios compared to similarly rated countries. This makes Moody's the last of the three major agencies to strip the U.S. of its top-tier rating, following Fitch in 2023 and Standard & Poor's in 2011. COT reports. The downgrade was triggered by U.S. federal debt exceeding $36 trillion. The Congressional Budget Office projects this figure will grow by an additional $23.9 trillion over the next decade, driven by persistent budget deficits. Interest payments on the national debt have surged to nearly $1 trillion annually. Trading start. Now, here is the key point. The Moody's downgrade is fundamentally bullish for gold in the medium to long term. Here is why. The credit rating agency cited escalating debt levels and a growing burden from interest payments as key factors. The downgrade sent the US dollar broadly lower. The dollar index fell 0.7% to around 100.40. And when the dollar weakens, gold, which is priced in dollars, becomes cheaper in every other currency, which boosts demand globally. COT reports. But there is a nuance here. In the very short term, the Moody's downgrade actually had a contradictory effect. When U.S. credit is downgraded, Treasury yields spike because investors demand higher compensation for holding what they now perceive as slightly riskier debt, and higher yields are bearish for gold. Treasury yields spiked after the downgrade, with the benchmark 10-year note hitting 4.55% and the 30-year yield climbing above 5% for the first time since 2023. COT reports. So the Moody's downgrade creates this tug of war. Weaker dollar, gold bullish, versus higher yields, gold bearish. In the current environment, the yield impact is winning the short-term battle. But longer term, the structural fiscal concerns that caused the downgrade are genuinely gold bullish. And the fourth piece of the puzzle is the Federal Reserve. There is nothing new here from the Fed this week, but that is the story. While the Federal Reserve remains in a wait-and-see posture, officials have signaled that interest rates will remain elevated for some time to combat energy-driven price shocks. The metal has been pressured by surging U.S. Treasury yields and a resilient U.S. dollar. The Fed cannot cut because inflation is running at 3.8%, nearly double their 2% target. They cannot hike aggressively because the economy has pockets of weakness, so they are stuck. And when the Fed is stuck, the dollar stays firm, real yields stay elevated, and gold struggles. Part 3. Pulling it all together. Is gold bullish or bearish right now? So let us now answer the question everyone wants to know. With all of this, the chart, the trade deal, the CPI data, the Moody's downgrade, the Fed, is gold bullish or bearish right now? My answer is this. Gold is bearish in the short term, and that aligns perfectly with my technical analysis. Here is why. Let me give you the full picture. Bearish forces. First, the US-China trade deal has removed the single biggest safe haven premium that was in the gold price. That risk-off premium that built up during the trade war is now being priced out. When risk-on returns, gold sells. Second, US inflation coming in at 3.8% means zero chance of a Fed rate cut in 2026. High rates equal high opportunity cost for holding non-yielding gold. That is a direct structural headwind. Third, US wholesale inflation is also surging. PPI data this week came in at its highest since 2022. This reinforces the Fed on hold narrative even more. Fourth, gold was already down about 4% for the week as of Friday, pressured by these inflation concerns and the risk-on shift from the trade deal. Bar chart. Fifth, the technical picture is completely aligned with the bearish fundamental thesis. Rejection from 47.64 supply zone, structure broken, price already at 45.39. Everything is pointing south. Bullish risks to watch. But I want to be honest with you. There are forces that could interrupt or reverse this bearish move. The Moody's downgrade is a medium-term gold bullish event because it undermines confidence in the dollar as a reserve currency. If there is any escalation in the Iran conflict, particularly around the Strait of Hormuz, oil would spike again, risk-off would return, and gold would catch a bid. Central banks have purchased over 1,000 tons of gold annually for 3 consecutive years, a trend expected to persist through 2026. That structural demand provides a floor. And if the Fed eventually pivots, which it will have to do at some point, Goldman Sachs has targets of $5,000 to $6,000 for gold longer term. But for this week, for this setup, for the trade that is in front of us right now, the bias is bearish.
So here is exactly how I am approaching this. I am not chasing the sell right now at 4539. Price has already moved significantly from the supply zone, and we are approaching oversold levels on the 4-hour time frame. Chasing into a move like this is how you get caught in a reversal. Instead, I am waiting for that correction bounce I mentioned. I want to see price retrace back up into the 4570 to 4600 zone, that pink correction box on my chart. This would be a natural technical retracement, probably triggered by some dip buyers coming in or a brief dollar pullback. When price reaches that zone and shows rejection signals, bearish engulfing candles, wick rejections, volume confirmation, that is the short entry. Stop loss? Above the correction zone, around 4620 to 4630. You want your stop above the PDL of 4644 so you have a clean structure reference. Target 1, the $sign liquidity zone at approximately 4500 to 4510. This is where those sell stops are resting. Smart money will sweep this before any meaningful reversal. Target 2, the full target at 4420 to 4425. That is the major demand zone from late April and where this move completes. Risk to reward? If you enter around 4580, stop at 4625, target at 4420, you are looking at roughly a 3.5 to 1 risk reward. That is an excellent setup.
Let me give you the final summary so you can take this and use it this week. Technically, gold rejected from the 4764 supply zone. Structure is bearish. Current price, 4539. Expect a minor correction to 4570 to 4600, then continuation short toward the liquidity sweep at 4500 and the full target at 4420. Fundamentally, the US-China trade deal killed the safe haven premium. Hot April CPI at 3.8% above forecast has completely eliminated any Fed rate cut in 2026. PPI also surging. Dollar firm. The Moody's downgrade adds longer-term gold bullish pressure via fiscal concerns and dollar credibility erosion, but in the short term, yields are rising, which keeps gold under pressure. Every layer of fundamental analysis supports the bearish technical setup. The only thing that flips this trade is a major geopolitical escalation. Another Iran event, a ceasefire breakdown, a sudden dollar collapse. Those are the tail risks. But based on what the market is showing us right now, the path of least resistance for gold is lower this week. As always, manage your risk properly. Never risk more than you can afford to lose. Use your stop losses. This is not financial advice. It is my analysis based on the chart and the data in front of us. If you found this breakdown helpful, drop a like on the video, leave a comment telling me where you think gold is going this week, and subscribe so you never miss a video. I am FX Market Pulse. See you in the next one.